Okay, thanks, Mark. So we've probably got time for 5 or 10 minutes of questions. If anybody has anything they want to ask the investment team. No?
Yeah, start off. Looking at the G20, the free trade agreement made with China.
Haven't looked at it yet. Okay. Well, it's just announced at lunchtime. Maybe we'll cover that next quarter in our update.
But is there a general feeling? I mean, it just seems such a surprise. What was announced, the extent of it. I don't know if it's a surprise. The extent of it. Is it good for Australia? Or, I mean, it's the trade has been very good for Australia.
Yeah, well, actually, I'm not an economist. I'm not an expert on it. You're probably closer to it than we are. And it does sound like it's going to be very, very positive. Obviously, reducing tariffs and that sort of thing. But I guess it's without going into the detail, my overwhelming observation is that the basic trade between Australia and China is us selling iron ore and coal to China, and we basically hit the wall with these two commodities in particular. I don't know, there might be other commodities that might benefit from the free trade agreement, but really iron ore prices just dropped from $140 a tonne down to below 80, I think it's 75 at the moment. And iron ore producers are under a lot of stress in Australia as a result. BHP and Rio can still make money at these prices, but Fortescue has $9 billion of gross debt, and it's not impossible Fortescue could go bankrupt, but these prices kept falling. It's probably break even at the moment and barely maintainable. So really it's about, in the GFC, Australia survived and was the only country in the world that basically, I think maybe New Zealand didn't have a recession, and that was really purely on the back of the iron ore story and the coal story, and really that's all now reversing, and as Carl said, it's not impossible we have a recession, and if we do, it'll be likely due to a commodity recession, which we're actually in the middle of, but doesn't get a lot of press. But things are very, very tough for in the mining side, which is a huge percentage of our economy. But it's not really directly talking to the free trade agreement. But I think that the free trade agreement will possibly offset some of that problem, but not solve that big problem.
Wouldn't agriculture be the major benefactor from the free trade?
Yeah, definitely. Yeah.
And there's reference to other infrastructure industries and things like that.
No, I haven't started. I'm sorry. Yeah. But you no doubt onto it that it is really significant. But
I just usually the Chinese don't do a deal with that.
Yeah.
I mean, the trade is a big benefit to Australia, but it must be a huge benefit to China rather than to
Yeah. There's got to be a catch. There's no free lunches.
There's got to be a catch.
Carrying on with the China question, China and US have just looked at the renewable sector again, where we seem to be going away from it. Do you see any changes that might be coming in the winds on the Australian sector?
Another question that we're completely on top of.
Well, China and the US have just announced agreements to head to reduce their global footprint by a certain percentage. I'm not up with it, but Australia seems to be heading away from the renewables sector, whereas this sort of emphasis may put more impetus into that area. So any upside for us here?
An upside for an investment case.
Yeah, investment case.
Not that I can think of on the top of my head now, but it really depends which way you come from. Tony Abbott, clearly in the last 12 months, he's been Prime Minister, is being less inclined to believe in climate change and have policies to reduce climate change. But I mean, whether it does or not, unless you're into the coal market, I assume that that will be one sector which is a positive. If Tony ever doesn't do that, I mean, I'm not big on coal shares anyway. Commodity prices are falling. I think they'll fall anyway, regardless of climate change or the policy in Australia. But yeah, the fact that China and the USA have are making more noises on climate change, I think that will be a negative for coal. On an investment sense, that would be the top of my head, that would be the biggest impact on stocks on the market in the Australian sector. It would be a negative on, say, our coal shares and the coal price as well.
Sorry, do you want to say a bit more?
What about gas? I just want everyone to switch into this.
So buy gas shares maybe, possibly. I mean, there are obviously a lot of other factors in these companies, so we would analyse it. We'd just be one factor in it. But yeah, other things being equal, coal companies less attractive, gas companies more attractive, wind companies more attractive. Yes. Okay, shall I cover a bit on where I'm investing, Anthony?
Yeah, you've got 1 minute.
1 minute. I'll give the brief version. Since about the last, say, 10 years, I've had what I've called a barbell strategy. The barbell strategy is about 80% in very low risk assets, and even more lower risk than actuarial planning suggests. For instance, I don't have any NAB HA, Macquarie Bank HB, because they're perpetual securities, so they can, 1% change in the margin can mean a 10% reduction in the price of those securities, which you saw in the GFC. I also favour shorter term bonds, like CBA HA, which is a senior Commonwealth Bank bond, whereas I don't like as much, say, the ANZ HA, which is 10-year term and it's subordinated debt. So you get a higher rate, but I think there's more risk on that. So I've got about up to 80% in a very, very defensive portfolio. But that means the other 20% I go very hard in, and I only have maybe 2 or 3 stocks in that other one. And if I like a stock, I'll maybe put 10% into the stock. For instance, Caledon is a stock that has tripled for me. So even though I've got a very defensive portfolio, if you've got 10% in a stock that triples, that adds 20% of the portfolio in addition to the return on the fixed interest portfolio. Plus I've had ASG Group, which has doubled in the last 12 months. So what I look for is very specific opportunities, special situations that are undervalued, deep undervalued, with a bit of a catalyst why they can maybe go up. I mean, the classic one I had, and thanks to Mark Hancock, after the GFC, was Rams Home Loans, which is renamed RHG Group. Now that one went up 20-fold. So if you have 10% of the portfolio and the stock goes up 20-fold, well, that means your portfolio will triple over that period. So that's been my strategy. Now, I don't think I'm all right. I've had 3 wrong in the GFC and 1 since then, but all the others have done quite well. So Caledon is under takeover, so that's about to go out. And like I said before, Medibank Private will be now my biggest stock position. Now, what I also do in that fixed interest portfolio, I also do what I call takeover arbitrage stories. And after the GFC, a lot of people had capital losses carried forward. So whenever there was a takeover, and particularly a scheme of arrangement takeover, which meant that you got a capital price plus a fully franked dividend, people with capital losses preferred to sell before the takeover because they got it all as capital, and that would be, they could offset their capital losses. But people who didn't have any capital losses wait until the end, and then you get maybe, say, a 3% return or a 5% return in, say, a 3 month period. That annualises at 12 15%. And every now and then, you get a really good one, like I had one bought cheese and butter, which we bought for a 3% return in 3 months, including the dividend. And then we had 2 other groups come on top, the Canadian company, Eager Cheese and Murray Goldman. And we ended up getting a 30% return in 3 months. So that really helped that defensive portfolio. But you've got to know which ones to pick. I always look at who the investment bank is, who the lawyer is behind it, who the acquirer is. And then we haven't got any wrong on those yet, but you never know. We do take a bit of risk, but if we can just keep churning that part of the portfolio, 3%, 3 months, and maybe 5%, like on Caledon, which is under takeover at the moment, you could have bought that in late October, and you get your money on the 23rd of December, and you would have made 4.5% in 2 months. And that's a pre-tax return. And if you're a zero taxpayer for a super fund, that's not a bad sort of return. And that includes a franking credit. That's put enough detail there, Anton?
So, with Medibank Card, could you go and buy 10,000 shares now?
Well, not now. It doesn't list until Tuesday next week, November 25. That's when they announce the price, and then you can go out and buy.
And are you predicting the price will be a good price?
I
When
don't.
it comes to
Okay. I just know that the government, Matthias, Cormann, and the rest of the government, are unlikely to sell it at a price above where it lists on, and they will know exactly what the price is because the book build will have occurred, like with all the book builds. One thing book builds do, if you understand what a book build is, the institutions have to auction in a way the price. So what that means is that typically with book builds, in the last 10 years, you get a lower stag premium because people know what the true price is based on what all the institutions are bidding. But you get less risk of a falling below that, particularly in the first week, because you know what the auction price has been. But on top of that, the fact that the seller is not private equity, like I don't like Myer because private equity is selling, it's always good clear of Myer. But when the government's selling for political reasons, they will tend to sell it below. So they may know that the true price is 220, and they will make price it at 190. And then with the extra demand on day one, it could be above that. But I don't know. They are not saying anything at all about allocation policy.
just from a practical point of view, if we take your advice and say this is the great share there, how realistic is that objective to buy a package?
Well, at $2, which is the maximum retail price, that 21 times earnings, which is a very, very high earnings number.
Could you buy 20,000 shares?
If it comes at $2, it'd be a highly liquid stock. It'd be probably the most liquid stock that day. So that's a price you can buy as much as you